Welcome back. It's Tim and Julie Harris, and this is your favorite real estate coaching and training podcast. And today we've got, as promised, a really great topic: 8 mortgage secrets smart agents use to close more deals. Now, what Julie did is she took a lot of time and she researched all of these different types of mortgages that are out there, a lot of which I imagine even some of your better loan officers don't know about. Now, we didn't get too much into the weeds about the different, FDA programs. Is it FDA? No, it's which is the one where for
They
farmers?
might have one, I don't know, but no,
Yeah.
FHA.
F8, yeah. So we look, well, there's going to be some gray areas that we have or some blind spots we have, but for the most part, we've created this information so that you now will have more information to share with your prospective buyers. And don't just think first-time buyers or don't just think buyers by themselves, but think in terms of the sellers that also have homes to sell, and then they too are going to become buyers. We don't know all the details yet about maybe it's going to be called Make Housing Great Again. We don't know what the new program is actually going to be called, National Housing Emergency, but it is coming and it is going to be huge. And the leading edge of these new programs is definitely going to be affordability. Prices are not going to fall on homes, but payments will fall on homes because it is absolutely clear to us that the pointing end of the stick to fix the housing emergency is definitely going to be through mortgages. People shop payments, they don't shop price. They don't care what the payment is, they care what the price is. Do you? Do you care what the payment is on something more than what you do with the price is? Because look, if you buy $1 million house and you can afford the payment, and you're in a market where home values go up by 3 to 5% per year, and sitting in that house, you're going to make $30,000 to $50,000 a year just sitting there. Go high house price, right? Because you can afford the payment. That's how the world works, and this is definitely what the Trump administration is going to be doing with regards to make housing great again. Now, I want to remind you, as we do on every show, make sure you're subscribing to our newsletter because that's the only place where you're going to get these notes. So just go to harrisrealestatedaily.com and subscribe to our free daily newsletter. Not just the notes from today's show, but all the previous shows, along with videos and a lot of other unique content we create just for our loyal newsletter subscribers. All right, Julie, let's roll.
All right. So again, 8 mortgage secrets that smart agents use to close more deals. Most buyers and even agents and brokers have been stuck in thinking the only way to purchase a home is the standard issue 30-year fixed loan with 20% down. It's not your fault. You were able to do that for many years and not even have to blink because that's what everybody did when rates were super low. But in today's market, that is far from the only option. Smart agents know the menu of alternatives and how to match clients with the right product. Knowledge equals confidence, ignorance equals fear. So let's build your confidence with this guide. Now, we are not mortgage brokers, so there's our disclosure, but we do know a lot about mortgages because we actually sold real estate in a market that was very infrequently what you might call hot. Okay. And when we sold, when we bought our first house in the early 90s, we did because they said, our parents were like, if you can close at 7%, you're doing great. And I remember, and you remember, closing a lot of our real estate transactions with our clients were at 8%, and they were happy as clams. Okay. Excuse me. And then there started to be different mortgage products and different things going on. So remember, we closed like tons of those 723 loans and all that.
But when you and I were, since you brought up a history lesson here, there weren't very many creative mortgages out there when you and I
No,
bought.
that's right.
It was basically 30 or 15 year, and that was about it. And then,
Well, until the 723 came out and the 80-10-10 came out,
but
and we did tons of things.
do you remember who rolled those out? You remember when
I think it
Countrywide?
was Bank of America for a while.
It was Countrywide.
Countrywide. Yeah,
Yeah,
that's
I
right.
remember when Countrywide offering
Tons
more
of country.
diverse mortgage opportunities came to town, the amount of activity that created in like a 6 month window was extraordinary. Listings started
Right.
selling faster, tons of new buyers in the marketplace, sellers that had been curbs, sitting on their houses for a long period of time, put them for sale. That's what's going to be happening again. There's going to
Right.
absolutely be a real estate surge. Make sure you're reading or you're listening to our past podcasts. When you subscribe to the newsletter, go to the search bar and look for the one that's Make Housing Great Again. You can also find those past podcasts if you just search on Google or go iTunes, Stitcher, Spotify, YouTube, of course, and you'll listen to all the reasons why we are 100% positive we're at the very beginning stages of what will be an absolute a historic real estate boom that will last a generation. And a generation, by definition, is 20 years. So yes, big thinking, but if you listen to our reasoning behind those thoughts, you too will agree. Julie, let's go right to point number one: adjustable rate mortgages or ARMs.
That's right. So we're going to start from the fairly normal and get slightly more exotic as we go through our different mortgage products here. So number one, adjustable rate mortgages. as you said, known as ARMs. These are great for buyers who don't plan to stay long term. So for each of these mortgages, we're also going to point out who is most likely to be able to take advantage of this. Great for buyers who don't plan to stay long term, lower initial rates versus fixed. So as of when we wrote this, the 5/1 ARM, so it's at the same rate for 5 years, averages about 5.8%. A 7/1 ARM is about 6% even, and a 10/1 is 6.1. So they're all, within spitting distance of each other. So an example, on a $400,000 loan, a 5/1 ARM at 5.8% saves about $270 a month compared to a 30-year fixed at the going rate of 6.22. So right off the bat, you can see the savings, right? Your action step is to record a quick video explainer. What is a 5/1 ARM, or even what is an adjustable rate mortgage, and how could you save on it? Is this right for you? Let me show you the real numbers from today's market. You might even show an example home. I would take the average sale price in your town and just, use that as your typical example.
Let's give them some advanced player mode on this one, okay? So Julie said, if you're not planning on staying in the house for a long period of time. So what's that to you? I wouldn't do an adjustable rate mortgage for a year. I mean, there were some of those during the housing boom. If you do a 5-year or a 7-year, most people, or a 10-year, let alone, most people aren't going to be in the house that long. But just because you sign up for a 5-year or 7-year or 10-year rate where the rate's lower for the first 5 years and then adjust whatever the market rate is or however the mortgage is written, doesn't mean you can't refinance out of that.
Or sell it. Or
sell it and just go from adjustable rate to adjustable rate, or just constantly refinance it. You can certainly do that and always keep the lower rate. And you can also buy down that initial rate. So let's say it's a 525 at 5.5% for the first 5 years, right? You can buy that initial rate down at the 5.5% rate to maybe 4%. So you guys getting what we're getting at here? Be creative, know the market. Julie, let's go right to FHA.
Yes, well, let me just pause for a second. You know who we would close with these 5/1 ARMs all the time were our relocating executives, because they knew that they were, it's not even up to them. They're moving in 3 or 4 years. So why would they do a 30-year fixed at a higher rate?
Right.
So it's I want people to not just think of first-time buyers, because when you hear about these different types of loans, a lot of people just go, oh, that's great for a first-time buyer. Makes sense.
Well, exactly. And again, we're 100% confident with the new housing programs. You're going to see a lot more adjustable rate mortgages. You're going to see a lot more amortizations. Might not be over 30, it might be over 40 years. Oh, it's a 40-year loan. Why do you care if the payment's affordable and the houses are going to appreciate to the point? Well, Julie was mentioning the house that we bought, in 1993 or 2, I don't remember, our first real estate transaction, which was 75 grand or something.
71,575.
There you go. And that thing's worth now probably 325, 350 grand. So even if you added up even if we'd still been there making the payment at 7%, which we wouldn't have been, we would have refinanced.
The payment was $550 a month.
Exactly. If you add that all up and you multiply it by, essentially figure out what that actual net return was, pretty damn good. And that's when rates were higher. All right, Julie, let's go to FHA loans.
Okay. Now in this case, generally this is mostly for first-time buyers, but you don't have to be. And also people with lower credit scores for whatever reason. Down payments can be as low as 3.5%. That's why we think of first-time buyers. They don't have any equity they're pulling from anything because they haven't owned a house yet. But down payments can be as low as 3.5% with a 580 or higher FICO score. So that's, lower than the 720 that conventional is going to want.
Jules,
ratios are also more lenient. What?
This is an FHA loan. You just said FICO, but we do know that FHA, VA, Fannie Mae, Freddie Mac, they're no longer using FICO as their.
They're using it, but they're also using some other stuff in addition to that.
Advance score, right? Isn't that what it's called?
I think that's right. That's right. Which is good news. Yeah.
It is a good news because FICO's 580 might actually be an Advance score 620. You don't know. And that's the FICO algorithm for scoring what your credit is, according to what FHFA came out with, was essentially disadvantaging so many people, hundreds of thousands of people per year. And they hadn't updated the way that, I don't know if this is just what I read, they weren't updating how essentially people nowadays earn money. So for example, if you drive Uber on the weekends and you work as a school teacher during the week, right? And you earn, $60,000 as a school teacher and $50,000 as a driver, you aren't getting any income credit essentially, or maybe half of your Uber income, they're only counting towards qualifying for a mortgage, or 20%. But now they're going to count 100% of it because you've been driving for Uber for a year. And why is that income worth any less than, say, for example, your teacher income? You get the point? Modern ways that people are earning money. Right.
Yes, and regardless of all of the credit changes, the point of FHA is two things. Smaller down payment is allowable down to 3.5%. That's, virtually nothing. And lower credit scores than any of the other conventional products. So that's good. And another thing is the ratios, your debt to income ratio, how much you're allowed to spend of your income towards your housing cost can be up to 50%. So that's way more lenient. So you put those three things together and you're going to have people qualified that were not otherwise able to get a loan. Where do you find FHA lenders? They're everywhere. Most major banks and mortgage companies like Wells Fargo, US Bank, are approved FHA lenders, but you can also search. You can use your AI. They're easy to find.
That's what I would
Not all
do.
conventional lenders do FHA, but there are lots of FHA.
But
Okay.
that's the go-to. You want to do your own homework before you talk to your lender because your lender actually might not be as schooled up on FHA loans, even though they offer them. Because, and I'm going to say this, and the lenders aren't going to like it, but y'all know it's true. They might be getting paid. Of course, FHA pays more commission than conventional, but they might be getting paid, be given a financial incentive to offer a certain kind of loan, even though that loan requires 10% down. Whereas your buyer could have qualified for an FHA loan where 3.5% down. So you need to be your own best, guru on these types of things. Use AI, do your own homework, and then talk to the lender. Sorry, Jules.
Yes, well, and it merits saying that you can. So one of the features of FHA is you can do that 3.5%, excuse me, down payment. You can also, if your buyer qualifies, or maybe some of you yourselves can do a 5% down conventional. So don't think that just because you've heard 30-year conventional for years and years and you've done so many of those, there is such a thing as a 5% down conventional. You just have to qualify in all other ways, right? Second thing about this is if I was holding an open house on a first-time buyer home, I would have something on my home brochure that said something like, think you need 20% down to buy a home? Not true. Find out how you can buy this home for as little as 3.5% down.
And have
Something like that.
And as we talked about yesterday on yesterday's show, when you're doing you're creating your newsletter, like we talked about, maybe also have a carve out where you write a specific article for first time home buyers. Because even if your primary audience there are people that have lots of equity and on their third homes in your particular area, they've got kids who are going to appreciate the content you're putting in your newsletter. Julie, let's move on to point number 3, which is VA loans.
That's right. For veteran service members and sometimes even surviving spouses who they themselves were not veterans, but they can qualify for the benefits. Now, you thought FHA was great. How about 0% down, no PMI, and competitive rates for veterans? Flexible credit requirements. And here's a myth busting thing I threw in here. Agents often think and sellers often think that VA loans take longer to close. In fact, data from ICE Mortgage Technology shows VA loans now close in about the same time as conventional, which is 45 days or less. Now, to find a VA lender, oftentimes your FHA lenders are also VA lenders. You can check the VA's official lender search site or ask your local bank or credit unions if they are VA approved or if they have VA approved programs. But here again, you can host a short video, especially around Veterans Day, but you can do it anytime. Here's how VA loans can get our heroes into homes with no down payment. You think that's going to get some legs? Of course it will. What if you live in a military town? Tons of Texas is full, for example, of veterans. If you are not versed on how to do VA loans, you're missing out. There's a lot of people that you could be helping.
I remember talking to my dad, and he was a veteran, and he didn't know that he had VA benefits. Mm-hmm. And this is back when you and I were selling real estate, and they were trying to refinance or whatever. And I found out, you need your little number. I forget what it's called to, apply for your VA benefits. But the terms and the conditions of the VA loan were so much better than what he was able to get from a bank. Way better. So if you run into folks and even if they're, they don't even realize they have VA benefits, a lot of them don't know it, they can use them. So there you go. All right, Julie, let's go on to the next point number 4, which is renovation loans, FHA, 203K, and Fannie Mae home style loans.
Yes, these are really interesting. This is how you roll a purchase plus renovation costs into one loan. Example, a buyer finds a $300,000 fixer and wants to add, $100,000 in upgrades or rehab. They finance $400,000. And I can remember we had some clients that did this. FHA 203K, the home has to be at least 1 year old and meet FHA minimum property standards after renovation. Fannie Mae has something called the home style. It's broader eligibility, including even luxury upgrades like pools. You can do a renovation loan to add a pool. Okay. So what if you're getting an objection? I can think of some coaching clients I have in mind that are in markets where they're the only house for sale for that price that doesn't have a pool. Okay. So maybe you offer a way, you find a lender that can actually do this and you can roll the cost of the pool upgrade into the loan. Also perfect for buyers struggling with lack of move-in ready homes. So you can finance that in. Again, there are some qualifications that both the borrower and the home have to go through. Excuse me. You can share before and after reels of renovated homes. You can tag it. This was a 203K renovation. Ask me how it works. Or afraid of renovation costs. Did you know you can finance them into your mortgage?
What a
And
killer,
this is not that exotic. This is a fairly standard issue thing people do.
what a killer tool for an expired that had condition issues.
Yeah, for sure.
Yeah, what a killer tool for those of coaching clients who are helping create their own cash offer programs, frankly.
That's
It's a
right.
fantastic idea. All
Well,
right,
what if
point.
you go on a listing and you know, I mean, maybe it's kind of a train wreck for whatever reason, and the seller's like, "Well, I don't have the time or inclination to fix all these things." What if you were to advertise? You could mention in your MLS verbiage, for example, may qualify for 203K. You can put it on your home brochures. You can do a reel about it. All that. Okay. Next, we have another little known thing. I told you we would get progressively stranger with these for some of our listeners. Number 5 is asset based and ultra high net worth loans. This is an approval based on liquid assets like investments and savings, not just income. Example, and I in the past week have run into 2 of these examples with our elite coaching clients. A retiree with 2 million in investments but modest monthly income can qualify based on their assets. So the typical mortgage lender would be like, well, I can't qualify you because you don't have any income. You don't have a job. You're retired. But a lot of people are sitting on tons of assets. So the requirements are proof of large seasoned accounts. A seasoned account was in existence for 6 to 12 months and strong reserves. Offered by private banks like UBS, Citi Private Bank, and Goldman Sachs. So again, you could do an explainer carousel, got assets but low monthly income. An asset-based loan could unlock homeownership. The cases that I had were people that were had been retired for 5 or 6 years. They were downsizing. They were selling out of a house but couldn't pay complete cash for something, so they just needed to finance 50%. But they weren't going to qualify with no job on a normal mortgage, so they're going to do an asset-based.
Well, let me give a real life example.
Yeah.
So I was talking to a friend of ours, okay, and he was asking me about this very thing, and he doesn't have regular income right now, but he has a lot of assets. He has like, in I think it was a UBS account. He had, several $1 million, and he wanted to take advantage of an opportunity to, and put money into something. And so I told him to do just this. I told him to go to his UBS. UBS handled all of his accounts and find out the most amount of money that they would use with the stocks that he had as collateral. And what happened was really surprising to me. They offered him a 90% loan against his stock values at only 4.5%. So he was actually able to go. He didn't borrow at 90%. I think he was just doing 50%. So he was able to pull out all the money he needed at 4.5%, and that collateral was already there from the lender. No other loan applications, no other of these, all the rest of it. So if you do run into someone with assets, which, by the way, the millennials are going to be inheriting $82 trillion from their baby boomer parents over the next 25 years, which is the impetus of our thesis that this is going to be the greatest housing boom in the history of the United States, if not the world. All that money is going to be flowing to these guys, these millennials. At the same time, a lot of them are going to be wanting to buy not just first-time buyer homes, but next move up homes, move up homes, move up homes. They're all going to be putting it into real estate largely. Of course they are, and other assets. Well, there you go. So people are able with assets to sidestep the entire mortgage process, which many of you don't even think of. So
I think these close a lot faster too, don't they? Because there's not a lot of paperwork.
No, it's a 24-hour wire. You fill out an online form and they wire the money to your bank.
It's awesome.
That's it. All right. So let's go on to the next one. Doctor and professional loans.
Yes. And you will recall, I think you'll recall this. The first time I came across this, you had door knocked a for sale by owner in one of our first neighborhoods we prospected. And he was a doctor. And it was the first time that I had ever heard. Back then, you didn't have massive student loans, but it was the first time I had ever heard that somebody had $100,000 in student loan debt. And my initial thought, as baby realtor,
He had like $250,000 in student.
was it that bad? It was
Oh,
like epic student loans, right?
yeah.
And I thought to myself, how's this person ever going to get approved? He's got like man-eating student loans, but he happened to be a doctor. So back to our point, number 6, doctor and professional loans tailored for physicians, dentists, lawyers, and other professionals with high earning potential. Benefits 0 to 5% down, no PMI, flexible debt to income ratios, and consideration for future income, including through residency and becoming a practicing physician, for example. Bank of America does this. Truist, Fifth Third all offer doctor loan programs. And yes, you could qualify in dental or medical school if you have an employment contract in hand. So they're basically speculating that you're going to be a pretty darn good risk because you're going to have good income. And I know that there are some special teacher and first responder loans as well.
They do the same thing for athletes and for actors. They'll loan you money. We worked with a lot of, agents in LA and whatnot, for example. And you'll hear about, so-and-so buying a bunch of real estate or buying some ridiculously expensive estate. And you're like, how's that actually happen? They're getting a loan against the income that they're going to be earning from an upcoming movie. And that's what a lot of them will do. Athletes will do the same thing. They'll get loans against future earnings. So if you don't know about these things and you have the prospect of working with some of these folks, don't think they know either. You're going to have to learn about all this stuff, and it makes you more valuable. Knowledge equals, confidence, ignorance equals fear. If you're feeling confident and you're happen to have an opportunity to talk with a business manager that represents some actor, and you're giving that business manager information that they didn't necessarily know about how their actor can then qualify for the house that they want to buy, that's how they do it. All right, Julie, let's go on.
Interesting stuff. Okay. Number 7, assumable loans. We talk about this off and on the podcast. Most FHA, VA, and USDA loans are assumable. Almost all of those 3 categories, meaning a buyer can take over the seller's low rate mortgage. Example, seller has a $250,000 FHA loan at say 3%. Buyer assumes that loan and finances the difference separately or pays cash for the difference. Game changing in a high rate market. So what do you do about this? First of all, find out if any of your listings are assumable, and you can add assumable loan potential. You're going to say the word potential because the buyer still has to qualify, but you're going to put that on your listing flyers, your social media posts, and certainly in the MLS. Buyers love the phrase, keep the seller's 3% mortgage. You think you're going to get shown first versus the competition? I bet you would.
How many expireds that are in your marketplace right now that have assumable mortgages, but the previous listing agent didn't know to ask that question? And then when you ask the question and they have an assumable mortgage, you've got a house that's not just going to sell, it's going to sell it to droves of offers. How many for sale by owners? The same thing. Knowledge equals confidence, ignorance equals fear. You're very welcome for this knowledge. Point number 8, mortgage porting. Now this one's crazy. I didn't know about it. Miss Julie found out all about this. Go for it.
Yes. Okay. Now I originally found out about this from some of the current administration's press releases and things like that, where they're saying these are some of the things we're looking into. So this is still fairly rare in the US, but it is being hashed out and considered to become more of a normal thing. It has already happened in the UK and Canada. Porting is basically transferring your existing low rate mortgage to a new mortgage. You still sell the house, you still pay off your old house, but you get to keep and port your old interest rate to the new loan. Example, homeowner with a $300,000 left to pay off at 3.5% sells, but buys a $400,000 home. The $300,000 part of the loan is ported at 3.5%. The additional $100,000 is financed at today's rate of say 6 or 6.5, something like that. This is a conversation starter. This is something I'm going to set up my Google News alerts about mortgage porting because it's going to take some time to get this normalized. But imagine keeping your 3.5% rate when you move. It's, again, currently a little bit rare here, but very popular in Canada and the UK. I think it's a great idea. You're not even, doing it for the whole loan. It's sort of like a portable refi in a sense, except that you're keeping your best rate. So that I do hope that gets some legs because that will break loose even more inventory and get some of these, the locked in effect that we hear about all the time, that I'm locked to my previous mortgage. Why would I dump my 3.5% mortgage rate if I didn't have to? So I'm not going to move. This could change all of that.
How much did you learn on today's show? And this was in how much? 26 minutes, right?
And only 8 points. I could have made it longer, but I thought that they would maybe lose stamina.
Yeah, exactly. Well, So
Or we would.
here's a thought for you. Knowledge equals confidence, ignorance equals fear. Notice how you're feeling confident. Here's what I want you to do. Join us for the upcoming mastermind that we're going to be holding for you called harrismastermind.com. The link is down below. And when you do, you're going to learn how to overcome the 3 biggest challenges agents are having right now in this marketplace. The mastermind lasts about 2 hours, so make sure you schedule yourselves appropriately. Julie and I are doing it, providing a lot of obviously information to essentially fuel you guys up for what's going to be the best year of your life next year, professionally speaking. And you can see, for example, just from today's show, all the different levers that most agents, let alone brokers, don't even know about that are going to be happening in mortgages. So listen, if you're listening to us over on iTunes, please do give us a 5-star review, and definitely leave a pithy comment. If you are over on YouTube, subscribe and also give us a great comment. Anytime you want to send us any ideas for shows, you can message us over at our Instagram account. It's at Tim and Julie Harris. In the meantime, have a fantastic day. Great show, Julie. And we'll talk with all of you on the show tomorrow. Hello, thank you for having watched this video. Please remember to subscribe to our YouTube channel.
That's right. And don't forget to hit that like button, leave your comments and questions below, and we will get right back with you.
Thank you for watching this video. And remember to watch the next one. You're going to love that one.